Guys and ladies, welcome to the show. It is Dfi-nancial Friday. I am so excited. We are on a new platform today. We're
Yeah.
streaming also on Twitch, so gonna give a little bit more of an introduction this time around. Again, this is Dfi-nancial Fridays. My name is Alfred from DiversiFi Capital. We are a financial planning education firm based out of the Bay Area in California. Welcome again. We stream every Fridays across YouTube and Facebook, and now we're joining Twitch as well. So Raymond, one of our partners at DiversiFi Capital, joins me every time. Raymond, how are you doing?
Doing good. Doing good. Excited as well to add another venue to our streaming. So hopefully getting some more capture there.
Yeah, you know what? I think it's a little bit different, right? I think recognizing, especially in this past year, the amount of people that are interested in finances,
Mhm.
it's gone all the way down to a much younger generation. Look, I'm on Twitch, probably watching a little bit of Call of Duty
Playing games.
Warzone, right? Learning to be better there. Got a couple of our team members that we play together on that, so that's fun. But I think it's nice to bring a different aspect of this to a younger generation, so that hopefully they can continue to learn more about finances. And it's one of our passions, right, to be able to share with everybody how to build that financial education so that you guys can continue to build that better future with your money. And it starts with today, where we're talking a little bit about what's been so popular, options trading. And so we'll get into that in a little bit, talking about some of the basics there. Look, I mean, I'm not going to sit here and tell you I'm an option expert by no means, but I think the main thing is when we talk about options, there's some really key basics to understand. And that's what we're going to start you guys off with. In any of our shows, what Raymond and I do, if this is the first time that you guys are joining us, we go through a little bit of a market update, okay? And we come from it in a standpoint of trying to be, simpler. We don't want to use much jargon to be talking to you about this with. So hopefully it's an easy listen and just giving you guys a little take of what we're seeing in day-to-day markets. Okay, before we get started, because compliance is key, we have to talk about our disclosures. Anything that we talk about on the show today is for general kind of financial planning knowledge and education. It's not meant specifically for personalized financial advice. Now, there's a place for that. You can visit us on diversificapital.com. There's a get started page there where you can learn about how our services work if that's something that you are interested in. We are going to be talking about investing today, right? So anything that we talk about in terms of investments, we're not soliciting you to be buying any specific investment products. Particularly today, not telling you to necessarily buy options, right? Stock options. There's a high risk to that. And what we're really wanting to talk about is just understanding the basics of it. How do you get started with options trading? What is an option, right? Why do people do it? That's what we're going to actually be going through. Okay. Outside of that, if we talk about anything tax related, right? We're not your tax professionals, right? We have contacts for that, but refer to your own tax professional and use this as more of a way to say, am I asking the right questions? And in fact, Raymond, that's what we do, right? We want to talk about these topics so that you're able to start asking the right questions, saying, like, is this like something I should be focusing on, doing more research? Because I mean, social media, right? The power of the internet, the amount of information and how quickly it flies. It's so you can learn so much out there, right? And so we have no problem also, especially today, referring you to a couple links that I think are really helpful, right? For you to learn about more in details on your own about options. So let's get started. Talk a little bit about, right, what happened in the market last week. It's a little follow-up to the week before where we had a little bit of a losing streak. And then this week, man, right?
Yeah.
NASDAQ here actually, right? I mean, okay, S&P down 2.5%, decent, right? Like not quite like correction levels or anything, but we're seeing a little bit of a pullback. NASDAQ, being the growth stocks of the market, definitely got hit hard, right? And we're talking down 5%. What are you seeing? What's causing some of that you're thinking, Raymond?
Yeah. I mean, growth stocks have done super well the past year, seeing how they rebound and even done 40% last year, right? They started off the year hot. Even as of year to date today, Nasdaq is still up and still beating S&P 500 and Dow Jones at 2.36%
Yep.
for Nasdaq compared to S&P 500 at 1.5% year to date, and Dow Jones at about a little bit over 1% year to date, right? So I think a lot of investors are starting to see some overvalue within these growth stocks, these tech companies that
Yeah.
have done so well. So they're starting to pull back on some of that, switch a little bit over to some value stocks, which are more of the well capitalized, or the blue collar jobs there that, with the vaccines and how they've been working. Been reading a lot of encouraging reports that the vaccines have been doing well. We'll start to see some of those things reopen, right? So
Yeah. And I think for me, what you're seeing is okay, by the way, right? NASDAQ last year did something like 44%. I mean,
mhm.
that's wild, right? Growth stocks did tremendous last year.
Yep.
And those that have followed on our show, we've talked about that a lot. We've talked about how there was a huge difference between something like the growth stocks in NASDAQ versus S&P 500. The 500 top companies in US did about 16, 17%. And the value companies, the companies, right, that Raymond you're talking about, the well capitalized, meaning they've been around for a while, they have money in the bank, right? They're more companies that are more stable. They only did about 7% or so last year. And so it's not surprising to me that they are pulling back a little bit more, but also in general, you're going to expect something like growth stocks to be more volatile. Part
Mhm.
of it is also, right, when you're thinking about growth stocks, think about it this way, right? Growth stocks maybe tend to need to borrow money a little bit more to be able to continue to grow. And so this past week, there was a pretty significant event in the US Treasury kind of auction. So think of it as just where the US, debt kind of situation is. It sets some precedents around where interest rates are going to be long term, right? And so
Mhm.
you saw a pretty large uptick in those bond, right, or treasury debt yields. It went up a little bit. And so there was this worry around how inflation meaning prices going up in the future, is going to be at down the line in 10 years. And when you had this case happen, interest rates ticked up. And all of a sudden, people are like, wait a minute. If interest rates go up, how is that going to affect growth stocks, right? And so
Mhm.
the growth stocks, I think in general, people were feeling a little bit more worried already at the beginning of the week. And then when you had this uptick in interest rates, it continued to make people feel a bit more nervous about what the potential future is going to look like for them. And you might ask, like, where is this inflation fear coming from? Guys, we printed so much money last year, right? With the amount of money that was printed to put into the market, put
Mhm.
into the US economy due to COVID, that's at some point going to play a part. Now, if you track inflation, there's a data point that you can look at. We call it CPI, right? It's one way to track inflation. That number hasn't quite gone up, too much just yet, but people are worried because maybe it's people haven't gone out and shopped yet because they're still locked down. So that as people do go out, right, you might see a situation where all of a sudden, right, inflation starts to skyrocket. So there's that worry there, Raymond, and I think that's
Yeah.
where we're seeing some of the growth side pull back. And so, it is something to watch for us. It's something as a company we're watching, but it's good to just explain to you guys a little bit why we saw, right, the Nasdaq pull back just a splash more. I want
Mhm.
to say a splash; it's almost double, right, more than
Yeah.
what the S&P did. Yeah.
Mhm.
Now, when we go through that, what else? Stimulus plan, right? That's still coming through.
Of more printing money again. Another 2 trillion that the administration is trying to pass, hopefully by mid-March. But I think a lot of people are looking towards that, right? About looking for some stimulus checks that we got last year.
Yep.
Surprisingly, it's been 8, 9 months, and this is still the second one only. But hoping for about $1,400 in terms of direct checks to individuals and families within certain thresholds for the income, and extensions of unemployment benefits as well, and trying to help some of the cities and having some funding there. So
Yeah. Um, yeah, I think this is a good overview, and but I think a lot of people are here also to want to hear us talk a little bit about options, right?
mhm,
Options are to be honest, a little scary sometimes, right? And
Yeah.
you know, the reason it's scary, and I'll talk about it, is that you are using not as much money to be buying into something that is worth a lot of money. And I'll explain what that means in 1 second. Okay. But in general, when we're starting to talk about options, right, we want to first talk about like what is an option. And then we're going to talk about why people trade options and then go into some of the basics of it. Okay. So, first off, in the terms of the financial world, right?
Mhm.
An option is considered a derivative, right? And so a derivative means that the value of this instrument, the value of this option is derived off of some other underlying asset. Okay. So now it doesn't have to be stock options. It could be commodity options. It could be a whole bunch of different things. Okay. But it's derived off of another value of an asset. Okay. But what an option is the giving you like the person either you buy or sell it, but it's giving you a contract. It's not necessarily an obligation, right? But it's something where you have a choice to either buy or sell something at a given price for a set amount of time period. So it's not an unlimited time frame. You can't buy an option hoping a share will go up, right, for an unlimited amount of time. Because if there was, it would cost a whole lot of money, right? Because there's some time value factor that's always built into these options. And the other thing is, once you've set that price, there are different types of options that I'm going to go through that are going to show you. Some you're limiting your up and downside, meaning you can't lose more money than this much that you put in. But there are types of options that have unlimited amounts of downside or
Mhm.
unlimited amounts of upside, depending on how you do it. Okay. And so we're going to describe that later in terms of option basics, right? Some very key, I would say, four strategies that I think are things that you better understand when you start option trading, right? Understanding at least the direction of how things move and how it affects your risk. We call those risk charts, right? Like it's something that
Mhm.
if you are interested in options trading, you should look up option risks chart, which shows you a little graph of in terms of profit and loss, and then a graph of where the prices of the stock and where you benefit versus where you don't benefit, right? But why is it? Give us some reasons, Raymond, that people trade options. Like, why do they trade options versus trade just a normal stock?
Yeah, a lot of times from our clients where we hear about, possibly purchasing options is to protect, right? To protect either some downside by buying certain options. You're also able to generate some income through the premiums that are received when you purchase options. It also provides shares to individuals who might not have enough funds to buy into that stock outright because you're buying a contract, so it allows you to purchase into that stock for a certain number of shares through margin, which we'll also talk about as well, which is basically borrowing money from the financial institution where these assets are held. But there's a lot of different and complex strategies that we have within options, but I want to just talk about the basics for today.
Yeah. And you mentioned one quick thing, right? Like, not needing to put in as much money to gain a much larger exposure, which also
Mhm.
means that, right, when there's a small price movement in a stock, option prices can move a lot more. Generally speaking, one option contract represents 100 shares or whatever the underlying asset is. But like if I'm buying an option contract on Apple, if I'm thinking that it's going to go up in value, right? I might, right, go in on a certain option position, but it represents, right? One contract is 100 shares of Apple. So the movement there can be drastic. It's also why people like to trade options because they like the volatility, right? Like in a stock price, right? What drives a stock price? It's driven by how well the company is doing, what the news is around a certain company, all of those
Mhm.
things. What drives an option contract pricing? It's driven by number one, how much time is left in your contract? How long did you make this bet for? So that's number one. The
Mhm.
second thing that it's driven by is how volatile is the stock, right? Because if the stock isn't very volatile, it's not moving very much,
Mhm.
right? The price of the contract probably isn't that expensive because the ability for someone to gain and loss on it isn't very high, right? Whereas if you're trying to trade a GameStop option, right, that's going to be one. Hopefully they allow you to trade it, right? But two, it's going to be quite expensive because of the volatility, right? And so that's something that gets priced in to the model as they're determining, right, the how to sell you or what you can buy the option for. And you can actually look up right there. You can say like, how does a option contract get priced? There's actually different models, financial models that it's based off of. And if that's something that you're into in terms of the actual math, you should look up like, how does an option gets priced, and you'll see different models that it's being attached to. Okay. Before we jump into the actual basics of some of these strategies, I think what's really interesting in the last 12 months for me is the amount of trading that has happened across across all of these platforms, right? I think a lot of people have gotten more interested in this. Maybe the pandemic has gotten people more interested at home to just, use some of their spare time and put it into the stock market and learning, right? And so, Raymond, tell me a little bit about, right, if I'm going to go open an account, can I on day one start trading all different types of options?
No. So actually, even though with technology nowadays, we're able to open accounts fairly quickly. There are going to be certain suitability requirements for a certain level of trading within your accounts, right? Outside of the normal buying individual stocks, ETFs, and mutual funds, if we're looking into margin, for example, or looking into options trading, there are things that you have to read in terms of a lot of disclosures to be aware about, right? Margin by itself, right, is you borrowing money from the financial institution based upon some underlying asset that you have, but there's also a variable interest rate you have to be worried about too, that they're going to charge you on a daily basis, but maybe assess it on a monthly basis. On options itself, they do ask certain suitability questions, such as, how many years have you been investing? How many years do you have experience with options by itself, right? How much funds do you have? So they do have their own set of questions to determine, what level of options that you can actually trade. So there are going to be different tiers. We're familiar with TD Ameritrade, Charles Schwab. You might see 3 or 4 different tiers where it might be covered shares, for example, or uncovered shares are the most aggressive. So a lot of times, unless you have a lot of experience, you have history with the options, even Schwab itself, after reviewing your inputs on those questions, they might not even allow you under that tier, right? So it still requires this kind of a step for the institution to approve you on a certain tier before you can even start on option trading.
Yeah. So just because you want to trade options, like just because you heard the news about GameStop and all these shares moving and you wanted to all of a sudden really make a bet, unfortunately, right, you're not able to usually make a bet right away. I think that's where some of the concern comes in. There was some concern that like someone like Robinhood or some of these new platforms, how quickly did they actually review everybody given the amount of users that went up for their suitability? So there's been plenty of articles out there lately about, right, talking about, did they do their proper due diligence to provide people with the right to trade these more riskier types of positions, which we'll get into about now, okay? When we talk about options, sometimes, right, there's options that when you get into it, there's some protection. There's not everything that you can lose, right? There's only a set amount and limited upside or downside. But in certain types of positions, you can actually lose an unlimited amount of money, right? Depending on how the stock moves. And I think that's where the suitability side comes in, because if someone gets into that tier to be able to, trade, for example, like you short, right? You sell a call and all of a sudden it moves in the wrong direction. It's possible that all of a sudden you're stuck with a huge bill that you didn't know, right, that you had. Like if the price continues to move up, there's an unlimited amount of loss that could happen in a short call, right? And I think that's where in this time period was the most scary for me during this, I would say Reddit trading, right? Was that, did people really understand what they were trading because the risk was quite high? I mean, you saw stories out there about somebody, right? Someone in college who unfortunately and sadly committed suicide because there was some display of a really large negative number in an account. I think it was ended up being an error, but still, right? These are things that worry me, is that how much understanding was there when someone goes into trading. So there are 4 basic strategies that we were going to talk about, right? I'm going to start with a couple of things. Something called a put and something called a call, right? A call option and a put option. Okay. So that's the first step to understand. A call option is having the right to buy, right? And a put option is having the right to sell. I'm going to leave it there for 1 second. Now, you can buy a call option, right? Meaning you're buying the right to sell at some given price for some time period. Okay. Now, you can also buy a put, right? Which is the same thing. I'm going to be buying the right to sell the stock at some price. Maybe that's because I'm trying to protect against the downside, right? I'm trying to always have the right to sell at a certain price. So I can buy it. And again, for a certain amount of period, it would then expire. Now, in both of those situations where I'm buying a put or buying a call, I am fronting some money, we call that the premium, right? To be able to own this right or option to do what I just said, whether it's the right to sell or the right to buy. Now you can go the opposite way, right? You can go the opposite way and you can say, hey, you know what? I want to sell a call option. I want to give somebody else the right to buy, right? Or you can sell a put option. I want to give somebody else the right to actually sell the stock. Now, in these cases, what we're talking about is something where you're going to collect now the premium from somebody by giving somebody that option. And there are different situations where these make sense, right? When you buy a call, right, you're buying the right to purchase at a particular price. Generally speaking, you are betting for the stock price to go up. Let's think about why, right? Because if I'm buying a call option, what I'm saying is I want to buy the right to buy some stock and buy a buy. I mean, yeah, no, so that's why a lot of people use long and short, right? Long meaning buy, right? Short meaning sell. But if you want to buy a call or again, long a call, what you're saying in this case is I want to buy the right to say purchase Apple at $100. I'm just using that as an example.
Mm.
And then when the stock price goes up, let's go, it goes to $200. All of a sudden, that contract is worth a lot of money because the price doubled. Yet I maintain the right because someone sold it to me to still buy, right, 100 shares of Apple at $100 when it's now worth $200, right? That's a huge win for me. Okay.
Mm-hmm.
Now, buying a call is good too if it goes down, right? If it's the price, and sometimes we call it strike price. So if it's at 100 and it goes down and now it's 90 in 3 months, let's say I bought the option for a 3-month period. If nothing happens, if the price never exceeds $100, then that option expired. We call it expired out of the money, meaning we didn't make money from it. And the only thing we lose in that case is the premium that we paid for doing so. Okay. So at that point, you lose the premium. Hopefully that's an amount that you were willing to lose, right? And you lost 100% of it, right? So, I mean, very, 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 very few cases would you actually lose 100% of your money if you invested in S&P 500, right? Invested in an ETF. But in an option, you can lose 100%, right, of your money by just having the option expire worthless, right? And so if you make big bets, you could like the premium that you put in. If you put $5,000, $6,000, $7,000 into a premium for buying a call and it moves the wrong way, it could expire worthless, and you just lost $6,000 to $7,000, right? Now, if you buy a put, it's very similar. It's a little bit more straightforward. What you're again saying is, I'm betting for the stock to go down, right? Because if I'm buying the right to sell, I'm saying I'm buying the right to sell Apple at $100, and during that time frame, if the stock price goes down to 50, I still get the right to sell at $100, and thus my contract is worth quite a bit of money because I maintain the right to sell at a higher price than where it is today, right? Opposite of that, price moves up, right? I'm not obligated. Remember, an option is not an obligation. So I'm not then obligated to buy at 100 when the share is at 150, right? And so at that point, again, the share expires worthless and I lose my premium. In that case, right, that's usually at the lower level of what Raymond said in terms of the option tiers, right? And the option tiers are saying like what kind of options or what kind of option strategies can you do? Those are at the lower ones because at that point there's some limited downsides to it, right? Now you might also hear, right? You might also hear these terms in option trading called like covered calls, right? And then there's this other one that, you know, a little immature probably when I was younger when I heard it, right? Made me uncomfortable in class. They call it naked calls, right? And so I'm going to talk about that for a second, right?
Yep.
But having a covered call or right, like is what you're saying is, or I guess just having collateral, right? Is having a covered position, covered call, covered put. That's saying that you own the amount of shares, right, that you're putting on the table. Okay. So if I do something where I've talked about buying a call, meaning buying the right to buy or buying the right to sell, on the opposite side of things where I'm shorting, this is where I said I'm selling a call or I'm selling a put. And so when I'm selling a call, what I'm actually doing is giving Raymond, I'm going to use you as an example. I'm giving you, right, the right to buy 100 shares from me at a given price. So what happens is, well, maybe the good thing is I have the shares. Okay. So I have the 100 shares of Apple already. And so if the price goes down, you're not going to want to exercise that right to buy anymore, because why would you? You could just go to the market and buy it for $50 instead of exercising your option at 100 to buy mine. But if the price goes up, all of a sudden, Raymond's like, wait a minute, I have this contract where I bought from Alfred for some price, the premium that he paid, but now I can exercise my right to buy for $100 when the price is worth 50. Or sorry, when the price is worth 150. So he's going to buy it from me, and then he could turn it around and sell it on the market for $150 and make the profit, right, of $50 a shares off of 100 shares. But for me, that was, you know, bad, right? Because I had to sell it at 100. But it wasn't unlimited risk because I already owned the shares, right? I already owned the shares. And it goes the same, right, for selling a put, right, which is selling or giving Raymond the right to sell some shares. In that case, I don't know that you'd have a covered position, but again, just talking about it in a situation where I'm giving Raymond the right to sell his shares, and if the shares actually go down in value, then I still have to buy, right? I still have to buy Raymond's shares for $100 when they're only worth 50, right? And so to recap those four strategies, again, four fundamental option strategies that you should understand before you even start touching the options market is when you profit, how much profit would you make? And is there a limited or unlimited amount of risk, right? With buying a call, buying a put, selling a call, and selling a put. It's like something in school where someone would put a chart up and I would need to say, just by the direction of these charts, understand, right, what type of strategy it is. And when you can do that, I think you can be a fairly successful options trader. But if not, right, if you're not sure what each of these strategies look like just by looking at the risk chart, then I don't know that somebody is ready for that. So if you take a look, right, I'm showing on screen. If you're listening in audio, right, again, give it a search. But these are long call, short put, short call, long put positions, right? And you could see the profit and loss, right? Do you have a limited downside or not? Do you have an unlimited upside? And in that position where I was talking about where I gave Raymond, right, the right to buy and the price, right, went through the roof, then unless I had the shares, right, then I have to go to the market and buy 100 shares at an infinite price and sell it to Raymond for $100. So I could lose a lot of money doing that. And so that's why, right, having a covered position, meaning I already own the shares, will limit some of the risk. And most platforms, right, would not let you sell naked calls unless you are at a very high tier of option trading. Okay. Now, of course, if you're at a very high tier of option trading, hopefully it's because you really understand the strategies. And when you do understand the strategies, a lot of money can be made by these more risky positions, right? You can have, right, unlimited upside to some of these things, which is also why that's really primarily what scares me. It's not necessarily that options that scare me sometimes. I think it's whoever is trading the options, do they have a full understanding of some of these charts? Because I'm standing here today on the stream saying that even for myself, right? If I'm not using it every day, it's not something I would remember, right? So you have to be doing it every day to be very comfortable. Okay. So once you've started to understand, right, these four strategies, you should be able to very quickly understand when do I make money and make that second nature. If you're starting to make that second nature, understanding the charts themselves, I think it's going to help you a lot when talking about, right, making the right purchase on what type of option to have. Okay. Now, finally, is it that when you look at some of these options, whether you're in the money or not, like, am I actually transacting 100 shares or 200 shares, right? Depending on the contract that you have. Generally speaking, no, right? What you're really doing is they will close out the contract for you, give you the profit that is implicit, or sorry, give you the profit that is derived from what the stock movement is, and then they just close out the contract. It's not like you're actually transacting shares of Apple or GameStop or whatever. They're actually just calculating the value that that contract is worth, and then going from there and giving you the money back for it. Okay. So I think that's actually a common misconception as well, where it's like, oh, I'm actually going to be trading all these shares, right? No, it's really you're working on the contracts themselves, and then they'll settle up the contracts and give you some price for it, whether it's a loss or a gain. Okay. All right. So I've talked a lot about these four basic strategies. Now, there are some very, very easy to understand articles, and I'm going to use Robinhood. I'm going to put you on blast here, Robinhood, right? You have given a lot of people, the power to trade options very easily. So they actually have a lot of good content on there. If you search option basics that show you graphically like how things look when you're buying a call, selling a call, I would 100% recommend you go on there because I think it's a fantastic tool for you to learn more about it. Investopedia, all right, I'm going to put it out there. Investopedia is a great resource sometimes also, right, to actually be able to just understand some of these basics in investments. And they also have a option basics trading article there, and actually has some videos of somebody talking about, right, options themselves. I think those are two great sources to go to learn more about options. All right. Man, I felt like I was talking for a while, Raymond. And you're like, yeah, you have.
Just a little bit.
It's a lot. I mean, it's something that I think we want to be very clear about how complex, right, options trading can be. And again, this is something that, on a day-to-day basis, it's a lot more, again, complex than, just stock trading. And I think you were talking about it, just how quickly things move with social media and information traveling.
Yeah, I mean, nowadays, as I mentioned earlier, it's just so easy for someone to be able to create an account in less than 10 minutes, fund it, and be access to those funds the next day, right?
Yep.
So this wasn't always used to be the case where people were able to open accounts that easily or place trades, but now that the pandemic happened and people are at home, people have some funds to invest, they're starting to get into the market, which is great overall, right? It allows them to learn more about the stock market. But it's also key to understand too that not every single year is going to be like what we saw last year, right? A dip was a good opportunity to jump in, and we saw a quick rebound, but that doesn't happen every single year. So it's definitely important to understand, even through options, because at the end of the day, it is more of an advanced, experienced trader that should be, participating in these types of options. One last tip that I would probably add would be just, there are certain apps through Android, through Apple, which allows you to play around with options before you actually play with your real money.
Yeah, paper trading, you mean?
Yeah, so that might be a good way for you to be able to experience, spend some time actually going through it, understanding, as Alfred mentioned, reading up on it, seeing how you fare, right? By you going with those paper training, and if it does work out great, awesome. Like, take it to real life at that point. But once again, like, just do your own due diligence and making sure that you understand things before playing with the real money there. So
absolutely. Well, thank you guys. We're approaching 30 minutes here. Loved having you guys join our show. Thank you for joining us. Just a reminder, right? I know that not every one of you out there watching us is able to come or even want to get personalized financial advice. Our team worked hard, not only putting out content like this for you guys so that you can share more of these topics and having the experience kind of be brought to a general audience, right? That's definitely our goal. We also recently launched an annual financial planner that's now on Amazon that you can buy, right? It helps you. Our founder wrote this themselves, right? Curated everything to help you organize your finances, and go check it out, right? We'll include the link as well for that. Just as a reminder, right? As we close out the show, we're here every Friday, 3 p.m. Pacific. And we hope that you guys subscribe, hit the notification button so that you guys know when we're going live. And every week, we're going to bring you a little bit of a market update that's easy to understand, hopefully. And of course, financial planning topics that we're getting from our clients so that we can share with you guys. All right. Raymond, happy Friday. Thank you for joining me. And again, thank you for everyone watching us live on the stream. We hope you have a great Friday.
Thank you, everyone. Have a good weekend.
Bye.
See ya.